Before we discuss the main topic, we need to define what this means. Imagine you have a series of loans and debts you need to pay off. This can be a hassle. Keeping up with all of these small loans can really eat at you, but imagine if there was a way you could take out one big loan and then use that loan to pay off all the smaller debts you owe. Baruch Silverman explains this in a wonderful article on debt consolidation. The result is paying one bill a week, month, or however long to pay off. Wouldn't it be kind of better to know once you pay off this big loan, all of the debts you owed are now finished? That you don't have to worry about the small details of specific loans or take the risk of forgetting about them? This is what's called debt consolidation. And getting a debt consolidation loan is what can really help you do just that. The loans can be very beneficial. However, debt is never a good thing. These debt consolidation loans are just meant to help you stay on track and also to save yourself the headache later on. So what are the different ways to consolidate debt? There isn't one way to just obtain a debt consolidation loan or to pay off all of these debts. The interest you pay on your debt can quickly become very expensive. You can use our calculator to help determine just how expensive your debt has become. In fact, there are numerous amounts of ways you can get them. What we're going to talk about here is the most common ways United States citizens get these loans. So let's dive right in. The first and most convenient method is balance transfer on credit cards. A lot of times we find ourselves owing debts to our credit cards. That's just how life works sometimes. Something comes up or some crazy accident happens and we need to use our credit cards. If you have multiple ones though, it can be extremely frustrating to fix and get in the positive. One way to aid this is by transferring your balance on your credit cards onto one account. Why do this? Well, a lot of credit card companies actually promote their low interest rates and say anywhere from 0% to 5% is the interest rate for the first 3 to 18 months. And as we know, interest rate fluctuations has been a big impact on any kind of investments. So how does this help you? This window of opportunity is available to pay off the complete amount you owe without adding interest. You could put the amount of all your credit card debts into one. With the company's no interest rate for a set amount of time, you have a window to not pay interest. This can all be extremely beneficial, especially since you don't have an interest rate for a while. Just keep in mind when your 3 to 18 months of no interest rate is expired. So how to consolidate debt by balance transfer on credit cards? If you would like to do this, you need to find a credit card company that lends the total amount you owe. There are downsides to these companies though. The con to this is potentially taking a hit to your credit score. Credit scores mean a great deal to us today, as they should. Be aware that stacking all of your debts on one card could hit your score. Other than that, you will need to meet some requirements. You will need a good credit score and a good credit history when doing this. We hope you already know how to get your credit score for free. Also, bear in mind that if you go past the window of opportunity for paying no interest, you will then be charged interest until the whole amount is paid off. Side note, remember that to transfer these debts to one card might require a service fee of anywhere from 2% to 5% plus. Pay attention to the details and understand all of them. Another common method is taking a loan on home equity. You could have possibly heard this as a second mortgage. Basically, this is taking out a loan from a bank or other lender and using your house as collateral to acquire the loan. This can be beneficial, but it also can be risky. Also, in this case, you should always pay attention to details and make sure you ask the right questions. Typically, the people who get these loans have good credit. They also have a fair amount of money in their house for it to be worth the loan. Usually, a key benefit to this would be having a lower interest rate. You aren't stacking a lot of money on top of what you owe, just a fraction of it. Also, you can put a good amount of money into your house and qualify for more money. You should be careful though. Note that this method puts your house at risk if you are unable to make the payments. This results in a foreclosure. Seeing those signs up and around always brings you to be melancholy. If you have ever had a friend or family member that had their house foreclosed, you know the tragedy and heartache it brings. It does have very low interest rates and can sound appealing and ideal. Just be cautious, especially if you have a family. You're making a trade-off for this loan. It's risky, especially if you aren't 100% positive that you can pay it off. If you fall behind, you can lose your house and be taken to court being demanded to pay up. It can really wreck your life, and it should not be taken lightly. Try reading examples on the internet about people's stories where this happened to them. The third method is credit lines. Getting a line of credit can help pay off your debts. Oftentimes, these credit unions and banks can get you approved for the credit line. You just need to have a well-fitting credit score and a good steady income. You can then use this to benefit your situation. Keep an eye on your credit score and make sure it's as good as possible. This can help you understand if you're likely to get approved or not. It also helps you understand whether or not you should be looking for lenders in the first place. Because of this reason, if your credit score is bad or even just okay, you won't be approved. The lenders generally like to have 100% feeling of the person they loan to. They don't like to risk. On the other hand, getting approved with okay interest might cause a lender to jack the interest rates sky high. It might not even be worth the line of credit in the first place. That's it for now. I hope you enjoyed, and don't forget to subscribe to our podcast channel on YouTube. We would love to know your ways to consolidate debt, so feel free to share them in the comments below.